Let's welcome on board Sunil Subramaniam as well and find out how he's bracing for the month of January and, of course, the calendar year. Sunil, hi, afternoon. Good to have you on the show and speaking with you for the first time this year. So wish you, New Year greetings from all of us here in the team.
Thank you and wish you all the same.
Right. Sunil, what's your anticipation about how the earnings season is going to pan out? And first up, of course, is going to be IT kickstarting with TCS tomorrow.
So I do expect that the earnings season will be better than the previous earnings season, right? But a lot of that is probably in the price in the sense that the excessive valuations got corrected with last time's earnings disappointment, and what has just come up now would create a smaller gap in the valuation. But I would still say valuations are not going to be cheap. So in the earnings season, I think it's the guidance which probably takes precedence over how the quarter by has gone past. So I would say the guidance will give a clear direction, and I'm expecting good guidance from IT, for example, from pharma, those both being external oriented. Banks are going to be a mixed bag, but I would still back them in the sense that I would say that any revival, either in consumption at the high end or in capex, has got to be supported by banks. And I see a very strong BFSI from the other side of the balance sheet, the savings investment pie. So I expect wealth management, AMCs, insurance broking, them to reflect. The 25,000 crore SIP book should lead to higher fees for all of these players, and some of that should reflect in the earnings numbers.
All right, that's the take coming in on the IT space. But moving on, let's shift focus to an ET Now exclusive then, wherein we learn from our sources that government may be looking to announce safety regulations for heavy vehicles. Move, of course, largely aimed at reducing the number of road accidents in the country. Let's go across to my colleague Sameer Dixit for more details on this one. Sameer?
So amid the rising concerns of the road safety, now the central government is looking to come up with the new norms for the road safety. The Road Transport Ministry is looking to install 3 safety devices in the heavy vehicles. And these 3 safety devices include, the first one is the electronic stability device, the second one is the emergency braking system, and the third one is the drowsiness safety and the alarm system. So these are the 3 safety devices. So when it comes to the drowsiness safety and alarm system, so this helps and it stops the driver, dozing driver, to keep off from the wheels. So they, in a drowsy condition, they won't be able to drive, or there will be an alarm that will pop up, and this will help to driver to regain and control the vehicle. So that's the safety device. And the other 2 devices as well, they are will be installed in the heavy vehicles to control the vehicle in a very uncontrolled situation, or when the vehicle goes beyond a specified speed limit. So these are the 3 safety devices. Currently, the active consultations with the stakeholders, it is going on. The ministry is consulting with the stakeholders. But interestingly, what we are picking up from our sources, that this consultation is almost at the last leg. A draft notification is likely to be issued by the ministry maybe within 2 months, and then this new norms will be introduced. And government is looking to make it mandatory that the heavy vehicles manufacturers in the coming months, they will mandatory install these 3 safety devices. And with this particular step, the government understands that they will be able to reduce the road accident, specifically where the heavy vehicles are involved. And this will also help to improve the scenario of safety for the heavy vehicles driver as well.
All right. Okay, just stay with us, Amir. The other important development coming in for railways as a sector is that, they're all set to be a big relief for stocks like BHEL, Titagarh Rail Systems as well. The issues pertaining to Vande Bharat sleeper train contracts will finally be resolved is what we are understanding. Samir, what more do you have on the same?
So that's a very interesting development. This involves Bharat Heavy Electricals Limited. This involves Titagarh Rail System and also Indian Railways. Now the entire story is related to Vande Bharat sleeper train, which is a sleeper-based variant of Vande Bharat. The country has been waiting for this particular and the new aged train for so long. And Railways is also looking to aggressively introduce Vande Bharat sleeper-based train on a long-distance journey. And for the same, the the tenders were issued and a contract was signed by BHEL, Titagarh Rail System. They formed a consortium and they signed a contract with the railways in the year 2023 to manufacture 80 sleeper-based Vande Bharat trains. They were supposed to manufacture 80 trains, and the price of each train was rupees 120 crore. Now there was an issue that Indian Railways or the Railway Ministry wanted that 24 coaches based train should be manufactured. So the entire train set should have 24 coaches, whereas initially the discussion was that only 16 coach based train set will be manufactured. So this led to a long pending sort of a discussion between the consortium led by BHEL and the Railway Ministry. But now what we are picking up from our sources that the entire issue has been resolved. Two things that has been settled, that yes, the consortium will manufacture 24 coach based train set. The Vande Bharat sleeper train will have 24 coaches, but yes, there will be no cost escalation, no additional cost will be given to the consortium, no price revision. Second is that yes, a relief has been given to consortium. Initially, the contract term mentioned that they have to deliver their trains by year 2029. But with this sort of ongoing issues, now they have been given an extended timeline. They have been granted an additional around 3 years of time frame to deliver these 80 trains. Now this is important because BHEL has also been looking to manufacture and show their capacity in terms of the train manufacturing and the technical capabilities, and this will help BHEL to get more contracts from the Railway Ministry in coming years.
With this, we'll let you go on that, and thank you so much for getting back-to-back two exclusive for us, one from the commercial vehicle and the auto space, and the other one from the railway sectors, wherein Vande Bharat sleeper contract issues have been resolved, and BHEL as well as Titagarh Rail are expected to be key beneficiaries of the same. But talking about the auto exclusive news flow, wherein emergency brakes are expected to be installed in all these commercial vehicles, and that's actually going to be interesting, wherein road safety has been one of the key concerns and the ministry is keenly looking onto that. Kunal, if you can help us with one of the key suppliers of these emergency brakes in India, and that is Bosch. Definitely looking at the product portfolio of Bosch, this is a very minuscule in terms of their contribution. But other than that, only on the technical front, how do you see the setup? Because what I see that the stock has been recovering from the day's low.
Yeah, it's been recovering for the days low, and also I think it's not been one of the few stocks which has fallen very sharply over the last 3-4 months, because there was a point where many of these auto anch names, they had fallen by a margin of 30%, 25% broadly in the span of the last 3-4 months. So it seems like that the stock is just going through a natural process of a mean reversion. So 3-4 months back, I think in the month of September, October, the stock was trading at 36,000, 37,000 levels. It's now come back to that 33,000 mark, which is just about a 10% to 15% correction for the stock in this kind of a time span. So I would believe that potentially the stock would start to look a lot more attractive at current levels. We would also look out for this that the stock, which is now trading just marginally below its longer term moving averages. I think even if it goes into a time-wise consolidation over here and not a major price correction, that also could probably indicate that this could be a stable territory where the risk reward would start to look very attractive.
Okay, that's that on Bosch. Sunil, what is your own sense? How is it that you marry and play as an investor the entire tech advancement that one is seeing in autos?
So I think that you've got to look at it that in the commercial vehicle space, if they got to introduce these things, it's going to be an additional cost. Now, in the demand cycle, unless the capital goods cycle pick up and heavy vehicle movement picks up, would they be able to pass on these costs, which are going to be mandatory from a government regulatory perspective, onto the product price? So then there could be a shrinkage of margins there. So one has to be very careful on the timeline of this implementation and how far if the implementation comes at a time when the CV vehicle industry on a rising trend, then the pass can be picked up. That's a good. But for the suppliers, like you mentioned, one of the companies there, Bosch and other suppliers, obviously it's good because it's a mandatory sale happening. So there's a regulatory profit that's coming to them. So I think it's a balance between the auto component supplier here and the ultimate product. And because it's a cyclical industry, right, the timing is very, very critical in terms of when these regulatory things come into force. So if they come in a boom time for the CV industry, then I don't see that can easily be passed through. And overall, this is good for the health of the country from a road accident perspective. So obviously, it's a welcome step as a country, but from a stock specific, you've got to be careful about who's going to bear the ultimate cost of these safety measures.
Certainly, Sunil, because the commercial vehicle industry of late has been doing pretty well for itself, while the hopes were really high in the mid of 2024. But in the second half specifically, we have seen all those hopes fizzling out. But one such stock that is seen to be under pressure today is indeed Paytm, because it's UBS that has flagged off in a note where NPCI data suggests no UPI share gain in the month of December coming in for Paytm, when Paytm's MTUs fell nearly 100 million at the start of 2024 to 68 million by the end of September 2024. The stock is almost at the day's lowest point. And Kunal, we did discuss about Paytm at the start of the day, and look at the move in Paytm right now, close to that 900 mark. Where do you see the stock headed?
Yeah, and I maintain the view that the stock is completing a mean reversion phase, so there should not be a trader should not be in a hurry into buying the stock, irrespective of what the last 3-4 months or the last 2-3 quarters have panned out for the stock price, because there's bound to be a point where the stock gets into a time correction as well as a mean retracement or a price retracement. So I think we are now starting that process for Paytm. My only concern is that if in case the volumes start to accelerate or increase rather, for the stock on the way down, then the intensity of the selling could be a lot more bigger for the stock. So I think that we'll maybe come to know over the next couple of days. But as of now, I would not be in a hurry to buy the stock at current levels. Yes, the longer term chart structure is quite positive. The stock has recovered from those 350-400 levels to almost 1000 plus. But then at 1000 odd mark, the risk reward was not favorable to initiate a buy. Expecting the stock to correct towards at least 850, 870 mark, that could be maybe a good starting point for someone who's missed out earlier.
Quite a bit of fall on Paytm, down about almost 904 points as we speak right now. But Kunal, what about your closing trades or other BTST trades?
Yeah, so I'll go with a few large cap names on the BTST side, and the first one is ONGC. It's been a fantastic last 2-3 days for the stock, again on the back of much higher volume. So expecting this trend to continue. 285 is a target for the stock, and stop loss to be kept at 264. And the second is about Tata Motors. I'm going a bit contra over here because the stock is trying to challenge this 800 mark, and if potentially the stock breaks past about this 800 level, this could be a swing breakout. So expecting the breakout for Tata Motors would be an anticipatory buy. Targets of 825, stop loss at 775.
All right, so those are the two BTST ideas coming in from Kunal, and interesting to note about Tata Motors, because just after any quarter ending, we do expect to hear from the company on their JLR updates. Believe that could be in a couple of days. So all eyes on that as well, because a couple of these brokerage notes are sounding positive and hoping for a good number. Let's see what's in the store. But Naresh, help us with your BTST ideas then.
So first is a buy on GAIL India, which can be a bounce back candidate given the correction. Stop loss at 189, target price of 199. Second is a buy on Indus Towers, which has been making a base around this 325, 330 mark. Stop loss at 330, target price of 340.
All right, those are the two calls coming in from Naresh. Buy on GAIL as well as Indus Towers is looking interesting at this point in time. But let's take a stock of what the markets are up to just 15 minutes or so when we shut shop. And Nifty 50 is almost getting ready for almost a flattish close, thanks to the kind of recovery that we have seen from the day's lowest point. Almost 180 points is what we have recovered, and 23,700 could be the next level to watch out for when it comes to Nifty 50. While for the banking index, yes indeed, some pressure does persist. 370 points of cut is what we are seeing. TCS is seen to be inching higher, 2% gain coming in on that particular stock. And other than that, Wipro, even one of the laggards in the IT space, is seeing a good day today. So is HCL Tech, up around 1%. But within the oil and gas space, Sunil, if you can help us with your take, because if we look at the earnings then, in Q2, there was a big disappointment rather from stocks like HPCL as well as BPCL. And since then as well, all these counters have done nothing actually. But looking at the valuations, and this time the analysts are building in for a decent set in Q3, will you be a buyer of any of these OMCs at this price?
Not yet, because I think overall in energy, see, China is a big factor in the prices, and energy is a part of global cyclicality. It's not just domestic. So I think we want to be consciously aware that unless there's a strong recovery in China, the energy pack is not going to go anywhere. The second is within that, the oil specific thing, OPEC has not succeeded in really getting production cuts to keep the price holding. With Trump coming on, and Trump's been very clear that he's going to pump more oil, he's probably going to reopen a lot of shale gas closed wells, and so oil supply is going to be quite high. So I see oil prices very stabilizing, and for these companies, as you know, the refining margins are linked to the landed price of oil. So to that extent, I think a flattish kind of a period for oil I see in the coming months. From that point of view, I wouldn't expect any great news. Yes, compared to the disappointment of the last quarter, it might be better, but still, I would say it's not a buy signal for me for this pack yet. I would wait and watch.
Okay, that's the entire oil and gas play, and Sunil's take on the same. But here's another ET Now exclusive, and we understand that insurance companies have shared their views with the industry regulator IRDAI over a possible changes in goods and services tax in policies. Insurers are now in favor of a cap of 12% GST, along with keeping benefits linked to input tax credit for health insurance premiums. Input tax credit is a levy which is placed on, to offset mechanism that allows insurance to lower tax liability. Anurag Shah, my colleague, is here with further details on the same.
In December's GST Council meeting, decision on insurance premium was deferred, and Finance Minister Nirmala Sitharaman said IRDA will provide crucial input on this matter. So IRDA asked insurance industry to send their suggestion on the GST rates on insurance premium, particularly on health insurance and term insurance. And as per our sources, insurance industry has submitted their suggestion to regulator IRDA, and insurance companies and insurance industry is in favor of passing off any reduction of GST to the policyholders after the adjustment of input tax credit. So insurers want reduction in GST rates on health insurance, term insurance, but they want input tax ITC benefit also can be availed by the insurance companies, and therefore only insurance industry is against the exemption of GST on any segment, and they want especially in a health insurance premium, insurance industry is in favor of reduction of GST from 18% to 12%, so ITC benefit can also be availed, and if GST is exempted on any segment, then insurers will not be able to avail the ITC benefit. So suggestions on this issue has been forwarded from insurance industry to IRDA, and this again is likely to be taken up in a next GST Council meeting. Group of ministers has already suggested about exempting senior citizen premium and term insurance premium, but now GST Council to take a final call after IRDA's input.
Right, Anurag, thank you so much for getting us all those exclusive details, what the industry participants are highlighting and what are they wanting at this point in time. But Sunil, if we can quickly have your take on the insurance pack, because just in the last GST meeting, yes, indeed, there was a disappointment coming in, but do you believe that it's just a matter of time where GST could be taken away or some relief could be in for all these companies? And given the kind of improvement in the insurance data, what we are seeing, because I was just reading a report wherein the general insurance has actually done pretty well, and it was some of these private companies that have done well for themselves when it comes to the December data. What is your take on the insurance pack?
I think that the levy that came on the GST a few months ago, I think it was not received well by overall, because it's something that hurts the middle class, because the companies would pass on this GST cost to the premium payer. So from that point of view, I think the government, but in the GST, the government is not the sole decision maker. The group of ministers, the states, all of them are involved. But I see that given the way the middle class gets impacted by this, and given that insurance penetration is very key for our country in terms of the rising, hospitalization costs and everything. So I think that this will move favorably. Timing of it is next GST Council meeting, and then they will take place. But I'm positively inclined that the government would be supportive of this measure, provided the rest of the states support it. See, the problem here with the states is that they are revenue hungry, and wherever they see ability to get a wider base, which is typical with insurance, they are hesitant. But I think overall better sense should prevail, and I think there will be some relief from the GST Council at the next meeting, and I think that's a good thing to look forward to.
Other than the GST Council meetings, of course, Sunil, wanted to understand what your anticipation and expectation from the budget is and how it'll try and become a catalyst for growth.
So I think that this time the budget is going to be a more balanced one. You know, for the last few budgets, the effective thing has been capex, capex, capex. And last year, the government has found that whatever they projected as capex, they're not able to spend, either because their own attention got diverted or because of the fact that sufficient this thing was not there, the impetus in the economy. And they've realized that consumption is getting hurt, partly because of high inflation, but also because consumer sentiment is not being very positive. So I think this budget is going to probably devote a greater deal of attention to improving the sentiment among the larger middle class and the bottom of the pyramid towards consumption. Because only when that picks up, ultimately private sector capex will pick up. So I think that this time, based on a lower base, I don't expect the government to end up spending the 11 lakh crore of capex. So there'll be a lower base on which the government will still project a good increase in capex, but they will allocate a far greater amount to consumption. They'll put a lot of it under developmental populism, that which helps create some jobs as well as populism. And so this developmental populism as a tilt is where I would see the budget headed. And that, if that is pulled off, because fiscal deficit wise, if you see what the data up to now, November, the government is very comfortable on fiscal deficit. GST collections and income tax collections have been good. So to that extent, without suffering on the fiscal side, the government is probably going to reallocate a little more towards revenue and a little less towards capex from a percentage growth perspective. If they pull off that, magic trick, right, then it's good because the consumption will support the short-term recovery of GDP and the capex will support through the longer term through the multiplier effect. So I think it's an interesting budget where you will see a balancing because they have to keep in mind the three stakeholders there. There is the larger Indian population, middle class, which is a stakeholder. Then there is the FII stroke rating agencies who are a big stakeholder. And the third, of course, is the government's own desire to push reform and capex. So balancing all of these three in a very nice way is a very eagerly anticipated budget for me. Because, mind you, where I see this change happening is because the government has learned the lesson the hard way. All this focus on capex over the last few budgets, ultimately when it came to the parliamentary election, GDP growth does not translate into votes. Populism is important, and that they realized. They course corrected for Haryana and Maharashtra. And so with UP and Bihar elections also in the pipeline before the next general election, that government will now make sure there's adequate bottom of the pyramid related populism measures also built into government programs. So I'm very keenly looking forward to how the government blends this in without it being seen as a fiscally profligate budget. So it's a very, very nice balancing act in Nirmala Madam's hands this time.
So we are keenly looking towards the budget, but Sunil, that was great to have your take on the budget expectations. But looking at the markets, then it's Apollo Hospitals that is now trading lower by 4%. And I do remember that just the day on Monday where we were just discussing about the rise in the cases, or rather the first cases being detected on the HMPV virus in India, that stock was one of the gainers in Nifty 50. Seems like a bit of a profit booking coming in on that particular stock since in the past 2 or 3 days there's been no incremental increase onto the numbers. But Kunal, just on the technical front, since this stock hasn't participated much in the selling that we have seen on the benchmark indices, do you believe that there's been a change in the structure of Apollo Hospital, and is the stock maybe in for some more weakness?
Yeah, there seems to be a change of guard for the stock, because earlier the stock was looking attractive. In fact, yesterday or day before, it was almost at a multi-week high in terms of closing basis, where the stock closed at 7,400-ish short levels. So today seems to be a big turning day for the stock on the downside. It's managed to come back now towards a multi-week low if it closes at the 7,100, 150 mark on closing basis, and this could probably be a strong indication that the trend is going through a sudden reversal or more of a knee-jerk price action. This could probably lead the stock maybe even fall back sub 7,000 mark. So from a trading perspective, I would expect at least another 150 to 200 points correction to the stock.
Okay, that's that on Apollo Hospitals and the kind of fall that it's having. We've managed to recover lost ground today. Didn't quite perk up in the green, but at least managed to recoup the losses intraday. But Sunil, good to have you on the show. Kunal, Naresh will let you guys go on that note as well.